I'm going to get a cup of coffee.
Perfect. Okay, guys, I don't know if you hear me, but you can see from the empty chair that Fred is not here yet because actually he was here, but he went to get some coffee. So he's coming back. He's going to come back. And today, just to as a reminder, probably you can see the title. We are going to discuss Saylor's model. So I want everybody to understand this. I'm sure when Fred comes back, he will have his. Sina is in the lobby. I don't know how to get in because I never. Fred told me to take care of the meeting until he comes back, but I don't know how to let Sina in. But what I wanted to say is that everybody, all of us, okay, he's back.
Yeah.
So let Sina in because he's there.
Yep.
So I was trying to finish my thought, and then maybe you guys can elaborate. Tell your own thought. I wanted to make the premise that we all love Saylor. So this is not a criticism about Saylor. We are not trying to say that he has done anything wrong or it has nothing to do with that, right? So actually, in a sense, we are happy that this happens. I always say, his entire company is supposed to actually recommend stocks or recommend certain investments. Of course, we have models. Of course, how can they do that, right? These are professions. We are not going to do based on feelings. We are going to do on some valid argument, and most of these arguments are like models. Now, maybe they're different from the models I build that are money or debt builds, that are more like physical ones, but they're still models. So we are not trying to criticize Saylors in any shape or form. We are trying to compare what he has given us, with our work, and then make some conclusions based on some valid arguments, hopefully. But it's not a personal criticism to Saylor. We are still loving Saylor.
Well said. Well said. All right, let's kick this off. So this is the Bitcoin Braintrust episode number 2. We have Giovanni, we have Sina, we have Stephen Perrinode from Money or Debt, and we have Matthew from One Base Money. So we're going to talk a little bit. This episode, we're going to focus. Oh, we have John Doe. Okay. John Doe as well. And who's John Doe, by the way? We know who John Doe is. I'm going to take John Doe.
Sounds like an average name, John Doe.
Okay, I don't know why he. But okay, so we have the 4 experts who've sort of studied this stuff. I have not really looked in detail at Saylor's model, although I've looked at some of you guys' analysis of Saylor's model. So let's start with Giovanni. Why don't you give us an overview of Saylor's model, and really what I think everybody's interested in is how does it compare to the Powerwall? So, floor is yours.
Yeah, and if you want to give me the chance to share, let me see if I can share my slides because slides are important. Okay. All right, so if you can highlight the slide, if you don't mind. So, and on one end, they say we are not going to be critical of Saylor, but at the same time, please give me this chance, not be mad with me. It's going to be a little bit of a relief because, there is what Saylor said and what people interpretation of what Saylor says was, right? Many people interpreted, in particular, I think, a group of people that don't like math in general, or they don't like the idea that we can, explain people's behavior with math or Bitcoin behavior with math, and they use Saylor's sentence as almost like a, you know a guidance and a mantra, like they use it like a mantra, like a religious mantra that they repeat it over and over again. And if there is one person that probably heard it most of the time, this idea, all the models will be destroyed, is me. I think I am the one that heard it most in the universe, and with all kind of animations where cans, being destroyed, etc. So it's a relief that actually now we know that sailors like models, so hopefully people probably will continue to do it, but in a much less aggressive way, because now we know that sailors is not backing up what you think you are trying to say. Diving in what after this release, stress release, let's dive in what
we should have played this clip as well if we had it.
Yeah, do you have it actually? Because we played it in our show, but do you have a clip?
I have it, yeah. But
do we want to play it? Fred, you are the boss. It's a clip.
Sure, you can play it, no problem.
Yeah. Go ahead, Cena, and play the clip.
Cena, yeah, let's play the clip.
Okay, let me see if I can share that screen. Yeah. Okay, you should now be seeing this, right?
Yeah.
Okay, let's go. And let me know if the audio works.
No, we cannot hear.
No, I'm not hearing. Wait a second. Wait. No. No audio on that one. That's really weird.
Sometimes sharing with the audio runs into problems. Let me use a different thing, like just the whole window. Nothing yet?
No audio for some reason. All right. Well, I think we can pass on that. And we understand. He basically
everybody knows. But
we've seen the clip. Saylor is lecturing Keith McCullough, who has this crazy model involving quads. And notoriously, he says to Michael Saylor, "Wait, if you're in quad 4, you can't buy Bitcoin, and you can't argue with that." And then Saylor looks at Keith and he says, "All your models will be destroyed by Bitcoin." And that was sort of the meme, the viral moment, and everybody quotes that as if it's some kind of general edict that you should not use models. And then now, of course, we're talking about Saylor's model, which is a little bit ironic.
Yeah. So anyway, yeah, exactly. So let's go and dive in what these models are saying. So basically, it's a little bit of a problem because as he doesn't really go in a very detailed explanation. The information is there. I think all the relevant information is there, but it doesn't really explain it in a way that is, that doesn't leave any doubt out. But we can do the best in terms of interpretation, right? It took us a little bit, right? We didn't immediately draw what we felt it was the last model, at least for me, right? I went to a couple of versions, and then finally I think I understand what the models are doing. But basically, I think the right interpretation is that there are 3 different scenarios. The bear, the base, and the bull. The base starts with a fixed percentage. So anytime you have a fixed rate, right, of return, this is a yearly rate of return, you are going to produce over time an exponential. So that is the first difference with the power law. They are not really power law. Now, if exponential is also losing some, the rate of changes, like in this case, it can look like a power law. Or, it can, because it's still an exponential, it can slowly change where it's kind of similar to a power law, and we will see some of the graphs. But in nature, the nature of this process, where the rate of return is fixed, will give it will create an exponential, not a power law. And then, for some reason, so why does it choose 50? My only interpretation, because at this point it's just a question of interpretation, that if you look at the real returns of Bitcoin, we are close to about 50% right now. This is what we are getting. In fact, the power law is in agreement. If we have a theoretical way of calculating the returns using the power law says more like 46% that we should do. So it's a number close to the real returns that we are observing right now. Now, what is it right now? That is the other uncertainty about the model, because it's called, here it say 2025, so next year, right? So one interpretation is that these models will apply starting January of 25. So that is, I think, the easiest interpretation. So starting January 25, we are going to expect a return of 50%. And then the next year, it will go down by 2.5%, all the way, sorry for that, all the way to 20%. And then when it reaches 20%, it stays stable. I don't know this component. I don't understand this component, because why is such an arbitrary thing? Why Bitcoin will arrive, it's decreasing all these years, and then it continues in a regular fashion where you make 20%. It sounds pretty good, because at that point, Bitcoin will be very mature, will be a big, large asset, and for that kind of magnitude asset, making 20% is amazing. And then he has the three different cases where we go down. Basically, notice we go 25 above, 24 below. So basically covering a relatively large range. And then the one that has
please, Giovanni, can you please make sure you're turning your pages, because make sure that,
yeah.
You know what I mean? So we saw the bear base case, but you have to make sure that the pages are turned. But I can't turn them for you.
Tell me again, turn them. Oh, the pages. I'm still on this page because I'm trying
Oh, you're
to
still on the page. Okay, I just
yeah.
One we're
So basically, there is a decrease, right, for each of the models that again to me sounds arbitrary, but it's smaller for the smaller case. For the bear case, 0.5%. So we go down 0.5% every year until we reach 18% in this case. Again, why 18 versus 20? Simply because it's smaller return. So we reach 18, we stop. I'm trying to reason, behind this model, why these values versus other. They seem pretty arbitrary. Besides, being spread in one direction, in the other direction. And then same thing with this more bullish case, where it's more bullish, but also we lose more. As we go in time, we lose 5% until we reach 25. And then when it's 25, we continue to do 25 forever, basically. It doesn't give us a limit. It's supposed to go, like it says, lower, it goes up forever, right? So this is kind of a summary. Basically, the next slide is kind of summarizing these. I try to understand how these equations will look like if you wanted to write an equation. So it's something like an exponential of an exponential, because if you have it starts with an exponential, but then if you have a decay that is also changing in time in this very precise fashion, then also that will be an exponential. So it's kind of an exponential of an exponential. It is a weird kind of curve. And, you can plot it in different way. I added this graph where basically I had these scenarios. I could have done something wrong in the calculation, and this is why it's good that there are other people showing the results. But the general idea is that the power law kind of comes in between. The base case is pretty close to the power law, and then the bear case looks kind of straight relatively to the other ones, and there is a wide range of values. one of the problems I have with this is that even if, they kind of look a little bit straighter, than a usual exponential, they are still exponential. And I made many times the case, I don't know why it chooses that form when the data shows otherwise, that if you plot the Bitcoin in a log linear chart, you can see the famous curving, right? That rainbow kind of behavior. It's not really rainbow because it's not going to curve down. It's going up, 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 up forever, basically, if you continue and extrapolate these.
I mean,
and Bitcoin is not like that.
Giovanni, to his
Yeah.
benefit, he's not saying it's exponential. He's saying it's exponential with an exponentially declining curve.
Right, but the functional firm that is using, so you will not still get the power law by doing that, because of the relationship. Is it true that they are very similar, but the decay needs to be very precise to get a power law? So if you have something that is different from, because in a sense you can describe a power law, they are very similar form. In particular, if you look at how the rate compounds, but it's a fixed rate. A power law, it's a fixed rate, and then you divide by a time. But and so that in a certain sense is a decay, right? But it's not the same decay that he described. So you will still get something. If you extrapolate over time, you will start to see some kind of exponential behavior. It will start to curve. And so it's really the wrong functional form. It's to me, it's problematic, because in general, we don't see this exponential behavior in Bitcoin. It could be interpreted, but one of the things that is important to do that I think Stephen did, you want also to project these different scenarios to the not just to the future, but also to the past, and see how well they do in describing the past data, right? And that I think Stephen did. I kind of tried to replicate his result, but I think I come close. I have this graph because I think I would like to give an opportunity to the other people to show their models, because I think Stephen has a very good interpretation of how it works, in particular using the price that maybe we expect in 2025. But my main criticism is this, right? That even if they look in the end kind of similar and they span a range around the power law, at that point, why should we go with these models at all if they kind of replicate the power law? When the power law is much simpler model, because these models basically have 4 parameters. They have 4 parameters because we are talking a particular rate as starting with. There is a decay that makes the second parameter. Then there is a starting point when you are applying the model. And there is this strange value at the end that it's going to be constant. Y is there, first of all, and it makes it like another parameter. So there are 4. And I always say that really the power law is only 1 parameter. In theory, 2, because to define a straight line, you need the slope and you need the y-intercept. But really, because we are using the genesis block as our starting point, we kind of assume that it's going to come close to that value. So it's basically 0. So if you want to be really technical, it's 2 parameters. Really, the main important one, it's the slope. You can even use returns. If you use returns, you make a power law model using just returns, then it's 1 parameter. You don't even need the slope. While these models, it's 4 parameters. So you make it more complicated. In science, Stephen has very nice slides to explain that, and he will elaborate more on this. But in science, we always like, not because it's arbitrary, nature really works in that way. Nature likes simplicity. So when something can be explained by fewer parameters, you always go with the fewer parameters, because then it turns out that this simpler model is closer to reality, even including social phenomena. Using fewer parameters is always better. And also, there is no really reason to believe that any of these models will happen. And I always insist, because that is my physicist point of view, that is my particular contribution that maybe Sina doesn't emphasize, I think a little bit Stephen emphasized, but I am the guy that talks about all the time about scaling variant, and I make a big deal about this because the power law is a special case. This is why it's such a beautiful function, because it's the only one that really has any validity in terms of making a scientific hypothesis that can, with a certain level of confidence, remember, it's just a scientific hypothesis. If we have a system that has been scaling variant for 6 orders of magnitude since we started to collect data, if you include the first transactions, it's actually 8 orders of magnitude, and that's been scaling variant over 15 years and 6 orders of magnitude, let's be conservative, then it's very likely that it's going to be scaling variant for the next one. That is basically when we go to 1 million, and maybe even the next one. I don't like to extend the prediction more than 20 years. So in 20 years, we will have 2 orders of magnitude, and it's very reasonable to say, given the system has this very special property, and only the power law has it. This is why I make a big deal about the other ones non being power laws. Then you can have certain, not certainty, but you can have certain confidence that this behavior will continue in the future.
So I just want to summarize for the non-mathematicians, because not everybody knows what orders of magnitude are, right? These are powers of 10, right? So what Giovanni's saying is, we've observed the power law from, let's say 10 cents to almost $100,000, right? So that's 6 orders of magnitude. If you go further back, it's even 1 cent and 1/10 of a penny. There were the very first sort of proto transactions. So do we believe that this model that is held for 6 orders of magnitude will hold for the next order of magnitude? Probably. And what about for the next order of magnitude? Probably 2, right? So we think at least another 2 orders of magnitude. So I think most of the people on this panel would agree that we think that mathematically it looks very probable that we will get at least 1 order of magnitude that follows the power law pretty well, which means a 10x increase in price from here, and possibly another 2 orders of magnitude. That would be 100x increase in price. So, Bitcoin 10 million roughly. Let's pass it over to, if I may, Giovanni, can I pass it over to Stephen?
Sure.
Okay, great. So Stephen, why don't you take over, and I'll let you drive the slides too.
Okay, let me see if I can get those to share. Are you seeing the slides?
Yes.
Okay. I'm Stephen, also known as Money or Debt. Here are my primary issues with what I call Bitcoin 24 scenarios. They're not strictly models. They're more like the kinds of scenarios that you put together when you're doing financial analysis and projection in a business context, if you were a consultant from one of the big consultant houses, or internal modeling for how you deploy capital. The first one has already been mentioned by Giovanni, which there are 4 parameters, being the starting growth rate, the decrease in the growth rate, the final asymptotic rate, and in some scale of what initial fair value is for the model or the scenario. The second concern is that these are empirical. There's no fundamental explanation as to why the parameters are what they are. And this is not the case with the parallel model. The parallel model has underlying fundamentals that relate to network theory and Metcalfe's law and the like. The third one is that the projections out to the next 20, 21 years are kind of all over the map. And there's a very large dynamic range. And then I note on this slide that, again, it does look like a double exponential, as was mentioned. So we've seen this. In the chart that I'm going to show, I assumed an initial fair value of $100,000 at the start of next year. It wasn't clear from their work exactly what they were assuming there. So to make things easy, and you can also kind of compare in your head, starting out at 100K in January, which is reasonable, but maybe it'll be 80K. Somehow they end up then with a bear case that out to 2045 reaches 3 million. I think that's assuming somewhat less than 100K, but of that order, maybe it's 80K or so. A base case of 8 million and a bull case of 49 million. So that's a broad dynamic range. That's a factor of 15 difference between the bear scenario and the bull scenario. So this chart kind of tries to capture everything that we want to present with respect to the Bitcoin 24th scenarios, bear, base, and bull, which are in the dashed lines, the power law, and the historical data. So if you look at year 2025, everything comes together. This is a log linear chart, so we're looking at the log 10 of Bitcoin price on the y-axis, and then the projections according to their rules for the three different scenarios. And you see at the end on the upper right-hand side that it's a 15 times difference between the low end and the high end. And we also see that the base scenario looks somewhat like the power law projection. We have the historical price in blue. You can trace back the power law fits very well through the historical price. That's the regression that we do when we do a power law regression. This particular one is a power law to the 5.7th power of time. And what I've also done, though, is take the same rules that the base, bear, and bull had, and I projected those backward. And so what I mean by that is, in the base case, you start out with a 50% per annum growth, and then you decrement that by 2.5% each year. So what I did is I incremented it going backwards in time by 2.5% per year. So I assumed 52.5% in 2024, 55% in 2023, and all the way back. And what you see is none of them fit the historical data very well. These lines cross over, right? Because of the nature of things. So the bull scenario is closer to fitting the historical data, but it starts out being kind of a floor, but in the early days it's a peak, and yet it's still off by 2 orders of magnitude in the year 2011. And if you look at the dynamic range between the base case, the bear case, and the bull case, it's a factor of 800, almost 1,000 difference between what the back projection to the year 2011 would be for those. So they're not consistent with history, with price history. Normally, when you want to do modeling, you're going to have to be consistent with the existing history for whatever the model is that you're building. Now, here's another way of showing that it's not a power law. And this is for the Saylor base scenario or model. And what I've done here is I've calculated for all the years from 2025 to 2045, what would a power law index have to be in order to match the same growth rate? And it climbs up to 7, plummets down to 5, and then because they go to an asymptotic growth rate, it shoots back up almost to 7 again. Whereas a consistent power law is that gray line, it's flat across this curve. So just a comment on why we look at power law models. Nature loves power law models. There are 4 fundamental forces in nature for physics. Gravity and electromagnetism are pure power laws, 1 over r² laws. And both nuclear forces, the strong and the weak, both have power law components, as well as some other terms. If you look at biochemistry, ChatGPT identified 4 different examples of power laws that apply in biochemistry. The first one is the metabolic scaling that we see in animals, and that goes as a 3/4 power of the mass of the animal. We see power laws in socioeconomic distributions, including income, wealth, consumption, city populations, firm sizes, stock returns, and many others. And what's most relevant for the case of Bitcoin is that communication networks and social networks obey power laws, and in particular, for our case, Metcalfe's law, which goes as a square of the nodes, and the addresses in the nodes have been climbing for Bitcoin is roughly a cube. So you take a square of a cube, you get something close to the 6th power of time. And this just shows a power law that you can do in block calendar time as well as Gregorian calendar time. It doesn't make too much difference. You still get an R squared of 0.95. That's the graph with the white background. And these power laws only have 2 parameters, the power law index and whatever the scaling constant is. But you can also do it against gold. And if you run a power law against gold, and here this chart is log linear. So it's logarithmic in Bitcoin price measured in gold ounces. It also has an R squared that's high, 0.94. And then the age of Bitcoin in years is on the x-axis and is linear. And it works actually against other assets as well. If we take the power law and project it, for this example, I took 80K at the start of next year. We don't know what that is, but roughly. And if we go out to 2045, we just take a power law of 36 years, which is number of years since 2009 relative to 16. We scale that up to the 5.7 power, we get 8 million. But importantly, this standard deviation is around a multiplicative factor of 2. It's about 0.3 in the log 10. And so what that means is 2/3 of our data points should end up in the 4 to 16 million range. And that's a significantly tighter range than the 15 to 1 that we see in the Saylor scenarios. And we don't need to assume an asymptotic rate. It naturally, gradually slows with time. And I'll close with this slide on Occam's razor. This has been around for over 600 years. A friar of William of Occam in the 14th century, and he's received the title of logician. I don't know how you received that 600 years ago, but history has given that to him. Said that the simplest explanation is usually the correct one. And there are a bunch of reasons: simplicity and efficiency, minimizing the number of assumptions, better predictive power, it's easier to apply, and parsimony in science is if you have competing hypotheses, you want to choose the simpler one. You don't want to overfit the data. If you put too many parameters in, you can have a polynomial of arbitrary order and you can go through all your data, but what you're doing is you're confusing signal to noise. What we want to do is extract the main trend, the main signal, and that's what we do with the power law, the main long-term trend. And there's a preference here for elegance and simplicity. And Karl Popper is quoted on this as well. So I will hand it back.
Well, I want to add that nature also likes simplicity. A lot of phenomena actually turn out to be simple, but there is a reason why we use it.
Great. Well, thank you very much. Stephen. And let's hand it over now to Sina for another look at this power law, and the Saylor model versus the power law.
Awesome. So let me. My sharing button has been disabled. Is there anything
What?
about it?
Oh, was it this? No, I don't know.
I can refresh.
Okay. Okay, I see. Here's Cena.
No, it still says unable to share screen. Something got disabled.
Unable to share screen. Let's see.
Try now because of it. I still add my slides. Try now.
Not yet.
I don't know why. I have. It seems like not British Hoddle is here, but I don't think that's none of us, right?
There's probably him.
Probably. I don't know how he got there.
Truly,
Okay, so we don't have. Is there any way you could send your slides to Giovanni or to me, and then we can try to turn them?
Yes, actually, it's very easy because I have tweeted them.
Oh, okay, great. So that'll be easy then. Hold on 1 second. Okay, comparing Saylor's model to the power law, that one.
But this is strange. I can't share.
Yeah, I don't know. I don't see a slide deck. I see annual returns versus Saylor law, power law. That one. That's the only one I can kind of see. Oh, you want to, no, that's the Cena. You can put it in the so okay, 1 second. Okay, 1 second. Okay, I got your thing. Okay, so let me now share screen. Cena. Okay, I think this is good. Is this the right screen?
Yes, it has both of the things I want to talk about. So let's talk about the second one first. Just click on the image so it's bigger.
Okay, 1 second. Is that good?
Yes,
Okay.
but before I talk about this, great comments from the two gentlemen. Over the weekend and the long weekend, we've been very active. We've recorded longer interviews with both Stephen and Giovanni. If you are more interested in a deeper analysis by these gentlemen, you can find them on our YouTube channel. We've already posted Giovanni's full episode. Stevens is being edited. And links to the YouTube channel is also available under my tweets. You can take a look at that. Okay, so what I have here, I simply, I don't want to repeat a lot of great comments was mentioned, but my goal was to simplify what Saylor has done as quick as possible and as concise. Okay, so when you look at his models, the main thing there is just an assumption on annual rate of return. Then everything else follows from that. So that's a place to really focus on. And the Saylor really follows the typical consulting model. You know, it's basically appears to me that he hired one consultant, and they, as they typically do, they came up with scenario-based analysis. So they have bear scenario, base scenario, and bull scenario. And even though they allow the user to manipulate some of these parameters, they also have their own thinking as default values. So if you look at the annual rate of return that Saylor assumes for the base case, as was shown previously, it begins with 50%. So on my chart, you can see the four curves. The white one is not an actual curve, it's a staircase trend, but the white one is the Saylor's base annual rate of return, the green one is the bull, red one is the bear, and then I also have the power law predicted, power law implied rate of return in orange. Now, Saylor begins with 50% in the base case, but again, as was mentioned earlier, this is inherently an exponential. So there's no asset that can continue to return 50% year after year. It will quickly run out of all the money in the world. It's just impossible. And we also see that in many natural events, exponential quickly exhausts all the resources in the system because it's too fast, at least for our world. So Saylor has a great intuition here, and he says, okay, this can't go on forever. So we begin with an exponential, but it's too fast. So next year we reduce the rate of growth. And then that's still too fast. So next year we still reduce it, until actually by 2035, the annual rate of return that Saylor has in the base case equals the power law's rate of return. And then it goes below that a little bit, but then he makes this weird assumption that, at some point, once we are low enough, the rate of return will stay stable. So then we keep the exponential trend, which can't just continue with a fixed rate. But it's also interesting that his assumption happens to be closer, at least in the base case, to the power law. You can see the rate of return is not crazy different. I don't know why. Perhaps because they just look at recent data and just modeled it after what exactly is happening in the data, which also well modeled by the power law model. So, but that was interesting. On the other hand, the bull case and bear case are widely different. Now, in the next chart, the one that's the original post to this, I have the predictions implied by Saylor's model. So if you can switch to that one.
Okay, 1 second. You want the first one now?
Yes.
Okay, hold on 1 second.
Yeah. So I think this one makes it very easy to compare Saylor with power law. We have the historical performance of the power law, and Saylor, only tries to model the future. There's no, they don't really do anything for the past to see how well their model fits, which, as we saw previously, it's a very bad fit to the past. But moving forward, his base case, actually the predictions that come out of it with all those corrections year after year ends up being very close to the power law's average prediction, right? So that's interesting. Again, that tells me that at least the consultant, did some work and adjusted the parameter. But the problem is that because they begin with the wrong functional form, which is exponential, it requires constant adjustment and correction, right? But the numbers are adjusted properly, more or less properly in the base case. But the bull case and the bear case, they just differ by 15x around the average. And think about it: in 2040, in year 2050, being wrong 15x means you're wrong by 15 times the world money or 15 times the real estate market. So it's just massive range of values. Essentially, the scenarios that Saylor has taken, it's pretty much everything that can happen. So there's no way for this to be wrong at all, because it's covering everything, and then it's also allowing the user to play and change the parameters. But I thought it's interesting that his base case happens to follow the power law prediction pretty closely. So pick whatever you want, but at the same time, if you want to be mathematically sound, first of all, as Stephen was saying, why use an ugly staircase? All right, so use an actual curve that fits the data properly, and it has been well tested, produces good out of sample results. This kind of analysis is just throwing numbers at the Excel sheet. Well,
I'd like to also point out that in the power law, it makes a model of expected returns, but it also gives you an idea on standard deviation, right? That comes from the model. And here we have this bull and bear, but we really have no way of talking about probabilities for either the bull or the bear, or there's no notion of standard deviation, at least in what anybody's shown so far. So is there any notion of confidence interval, standard deviation of volatility, other than just bull, bear, base? I don't think so, right?
No, yeah, that's a great point, because I'm personally a lot less interested in the point predictions of a model, even in the power law. Like, that's just an average, but in reality, it's a whole distribution of possibilities around the average. And you also need to have an idea of what's the expected volatility around the average, right? Because average will pretty much, it might be like a few seconds in a year that your average prediction materializes. Most of the time you're away from it, but it's important to know how much, are you expected to vary. And having the right model, which, you can analyze with the past data, also gives you a great idea of volatility. And that boils down to estimations of standard deviation.
And it also gives you, the other thing the power law model gives you, which this model doesn't give you, is it gives you an idea of the starting point, right? And which was mentioned by Stephen earlier, is the starting point on trend? Is the starting point at below trend? Is this the starting point at 2 standard deviations above trend? Because I guarantee you that the power law predictions are not the same if you're 2 standard deviations above trend, or as it happens that we're just a little bit below trend right now. So that's another reason why you might want to.
Yeah, that was one of the confusing things for me until I saw what Stephen did, because I didn't know how to interpret that. I say maybe it starts today, maybe it starts when the bull starts. I didn't know, and so I was getting different results, and then I saw Stephen that had the most reasonable. In fact, he kind of still right now we are still manning, if that is the expression, Saylor's model. We are trying to look at the most, let's say, benevolent interpretation, because otherwise we look even ugly. Like, for example, if you start and say, what if this started, I did that in one of my graphs, I say, what if you started at the Genesis block? Because, Bitcoin started there. That is what is the assumption for the power law. And you will get something that doesn't, it doesn't even go to the power law. Even the bullish model doesn't go there, because in the beginning we had this very, very fast growth, and that is not at all represented by these models. So there will be really, really bearish cases if you started at the Genesis block. They all below, even the bullish cases below the power law. Right now we will be like maybe, I have it somewhere, but the bullish case will be like $20,000, $15,000, or even less. So I don't know. I don't know what motivates this idea of making this model. Besides what Sina, I think also Sina interpretation is a very charitable one. Let's say these are consulting models. He instructed me on that and made me think it's a different world. It's a different way of thinking. Right, Sina?
Exactly. I can see like you're looking at it from equations and physics perspective, but first of all, in consulting they want to be quick. They don't have time to you and I have spent months. You've spent years on analyzing this. They're not going to do that. They're just going to throw in like a reasonable minimum and reasonable maximum and some average case, and then extrapolate. The hardest thing to do in modeling is get the assumptions correct. But that's exactly what some of these consulting projects skip. They just make random assumptions, not totally random, like intuitive or based on some experience, but not a whole lot of validation of those. And then from there, you have everything you need. You just do an Excel practice to extrapolate it into the future.
Listen, guys, I think we've covered it really well. I really want to thank all 3 of our presentations. They're all great in their own ways. And I want to we have a little bit more time. I want to let Matthew talk a little bit about monetary base growth and global printing. So Matthew, a little different subject than just sort of picking apart the Saylor model, but floor is yours.
Thanks, guys. Yes, I second and third all the comments made thus far. And yeah, just to summarize, I think it is quite funny that we've gone from all your models will be destroyed to we have a model, but it's prepared by some consultants that, as you said, you need much more time to try to dig into this stuff scientifically than just throw out a few bull, bear, and base cases. So yeah, that is that. Anyway, here's a little rundown for you on an exponential chart. So what we have here, as I said, this is the printing press. I just published the second quarter. It takes some time to get this together, but the second quarter of 2024 to this week, actually. And basically, we have all these different money supplies, M1, M2, M3. In my opinion, I talked about a lot. We're going to talk about comparing this to Bitcoin. I'm not going to do that during this quick episode. We can maybe do that next time. But this is the most apples to apples analogous money supply to Bitcoin. And what is it? It's basically what you call the monetary base, or all the central bank money in the world. So we have the Federal Reserve, Bank of England, Bank of Japan, PBOC, Bank of Brazil, top 50 currencies in the world. You see here, we're at the start, just before the financial crisis, we had about $5.2 trillion equivalent in global money. That is global central bank money. We went just before COVID to 20 trillion. And you can't even see the QEs. They sort of blend together when you take all the currencies together. 20 billion, 20 trillion just before COVID. And then during COVID, we got another 10 trillion slapped onto it. So there's really, the COVID by far was one of the biggest money printing episodes that we had ever. And now it's come off 4 trillion. So we're 30 trillion in 2022. Now, as of June 2024, 26.12 trillion. All right, that's the global monetary base. And that is like the core of the financial system, because all banks will lend money on top of that. Monetary base is just notes and coins in circulation plus the bank reserves. Bank reserves is like basically every commercial bank's account with the central bank. So that's the monetary base. You can also think of it as the balance sheet of a central bank. It's the liability side of the balance sheet, basically. All right. So we look at the trailing 12-month changes. We can see some big peaks and troughs. This is just straight up taking trailing 12 months. They're pretty high. Okay. You see sometimes here post GFC, we got up to 30% on a trailing 12-month basis. Then they tried to normalize here just before COVID. Remember, we had this repo spike in September 2019. This was basically repo rates started to spike, so it shows you something wasn't right. So they had to print money again. They're actually doing that before COVID started, and then COVID just exploded things. So we went here in February 2021, we went to a 38.8% year-on-year growth of global money. This is in dollar terms, and then we had a huge contraction here in 2022. But I want to show you a different view and explain something else. I'm only showing from about 2007 or so these sort of changes in the dollar value. Okay, but I can show you another way, and that basically is if we start not from the dollar value here, but we look at any given month, how many euros did the European Central Bank print, or yen did the Bank of Japan print? If we take, you can get basically a huge spreadsheet of monthly growth rates. Okay, then you'd have to weight those growth rates. So you weight those by the dollar value. You have to use exchange rates. It is true, but if you start with the growth rates and you don't look at the this sort of just dollar value of this blob of cash, you'll actually get a little bit different picture. And I can take this all the way back because it doesn't matter. Like, I don't have China data from before the year 2000, so on and so forth. As long as I have a basket of rates, I can still get a global weighted rate. So this is the thing that I've been publishing for about 6 years now, and that's going to be here. Now, really quick, you remember the compound chart that I did with Bitcoin a couple weeks ago, and Sina in his penultimate chart just showed it as well. You have Bitcoin's returns were about 100%, compounded, 10 years ago, and then they've trended down to 45%. That's the number right now on the curve. You remember that, right? So that's a power curve distribution. But if we took, as I've already alluded to, exponential, a little quiz for the cast members here. If it's an exponential and I want to take the constant growth rate here and just run it across time, what would that curve look like? Would it be downward sloping? Would it be going up? Or what? Anyone want to take a guess on what the total compound growth curve would look like over time if it's an exponential chart? You understand my question? It's a straight line. It's a straight line, of course, because it's exponential growth. Exponential growth is constant growth. So you can get away from all of the peaks and troughs, and you can actually get to one number here. It goes up and down a little bit, but if you took, you know, this is all the noise. This is trailing 12-month is the black peaks and troughs. But if you take all that away and you just average the monthly growth and you raise it to the 12th power, and it's all weighted and everything, you're going to get something that's pretty consistent. That can take even more noise. Let's just look at the total. You get to one number.
Wait a second.
12.7%.
So we can say 12, 13%, right?
12.7%, 1% a month, 1% a month.
That's probably a more appropriate way to think about inflation, right? Than CPI or whatever else you want to use. So if you're investing in anything that's returning less than 12.7, you're simply you're getting fooled, because and if it's anything is returning bigger than that, you're only getting the actual difference from 12.7.
And Matthew, you got this by averaging these ups and downs. So how did you get the 12%?
The 12% is all the monthly growth rates that are weighted each month. So, back here, let's say in the 1970s and 80s, the dollar was a bigger share of the basket because you only had about 20 currencies. Now I have 50, right? So back then, maybe the dollar would be 40, 50% of the basket. Now it's actually only 22%. So you take all of them. So whatever the growth rate is every month, you weight it by that month, specifically on that month. And then you'll just get this huge spreadsheet of monthly growth rates. You get one weighted average per each month. And then you can take the cumulative run rate, which is here. The dotted line will take that off. It takes a while to sort of set the pattern, but you can see that it's mostly around. Sometimes it's a little bit above 13%, something like that, a little bit low. And then if you get to the all-time number, which is the all-time average compound growth, it is here. So that's it's the monthly weighted growth rate of all central banks, as much as there is data. And there's a lot of data here. Raise it to the 12th power. That will give you, it's about 1% a month, which gets you closer to 13% per year. And the only caveat I would say, Sina, I totally agree with what you said, but of course that's the supply side. Theoretically, we know this isn't true, but theoretically, if the demand for this money was 12.7% per year, and the demand, and that would be measured by an increase in population, an increase in GDP, so on and so forth. If that was 12.7%, then you wouldn't have an increase in prices. That would be what they call the unitary price theory in economics. If it was unit per unit the same, there would be. But of course, we know that it's not less. And the question is how much less. And measuring that demand is very, very difficult. But, I just did, I did an exhibit on global population growth. It was 1%. It's a 1% growth. It's actually 1.7 if you do the trend line, but we're at 1% right now because that's just population growth. You look at, GDP in the US, it's anywhere from 3 to 5, but that number is pumped as well from inflation. So you go on down the rabbit hole. But yes, my point has always been from a corporeal, real thing is let's just look at how much they print. This data is out there. You got to find it. The World Bank isn't publicizing.
Stat that you put out, Matthew, is the day that Bitcoin was invented, right?
Yeah.
Roughly, we've had a 5x increase, 6x at its peak in terms of money printing globally, right?
Yep.
So we've gone up 5x in money printing. I just checked the S&P at that period. We were talking about 1,500 on the S&P. So the S&P is gone up 3.5 times, a little bit more, right? 3.5 times. So, stocks have not kept up with money printing.
Yeah, exactly. And I did that in the exhibit. I just showed it really quickly. 50 years on the S&P, 7%. And with dividends, 9%. I think probably Fred, when you were, I always remember being much lower, but I remember 6 and 8. Maybe when you were active, Fred, it was less.
No, you're right. I mean, and so there's just this money illusion on stocks, right?
Yeah.
Everybody is just like looking at stocks, but pretty much stocks, all of the return of the stock market index is inflation, is money printing, all of it.
Yeah.
Over 120% of it is.
Yep. Absolutely. So that I think this drills down on a lot of it. One more point I just want to show back to what I started with. If you look at now the difference between, remember, this is sort of the true month to month, which is annualized rate of growth. You can get, Y2K was 30%, big. Everybody was taking cash out then. Of course, global financial crisis, 32%, COVID, 30%. But look at it here, how it's kind of flat. And remember what I showed you if you actually take just the straight up, what's the change from 30 trillion down to 26 trillion? You would expect it's going to be like negative 10% a year, whatever. Well, that's the chart I showed you at the beginning. So this is quite interesting. And I'll drill down what I'm saying just in recent years. Okay, so the red is the change in the green. Very simple. Like you have a dollar values here. Everything's dollar, like in dollar code. We had 30 trillion in 2022. Now it's down to 26 trillion. That was the red bars. You'd be going down 10, 12% per year. But look at the black. That's actually what the units upon units that they're printing. Euros upon euros, yen upon yen. And if you're weighting that every quarter, being very rigorous about it, you actually see it as kind of flat. Yeah, it's down a little bit, but kind of flat. So what is that saying? That means central banks are actually printing or staying flat, but their currencies, as we know, they're falling in value against the dollar. So this is like a Wittgenstein's ruler thing. We have 50 currencies here. We can't show it. There's no North Star except for the dollar. But so when I do the North Star of the dollar calculation, that's in red. Things look negative, but they're really flat. Even with the rise in interest rates, globally weighted, they're a little bit negative, maybe 1% negative. Right now, they're negative. Right now, actually positive negative 0.3%. You see the black in the tooltip, negative 0.3%. What that is saying is the green shaded area of the value of this global pool of money is falling because other currencies are falling in value. But in reality, those currencies are kind of flat, sometimes even printing a little bit, those central banks. So it shows you that a lot of people say the dollar is going to zero, whatever, and that's fine. You can go crazy. The dollar is still the best looking horse in the glue factory. And that's what this shows, in that, the dollar value is falling here because other currencies value in dollars is falling, but they're still kind of flat. And as we know, they're going to start printing more pretty soon. So this is the global printing press.
Guys, I think, look, we just hit exactly the hour. I want to thank everybody because we had 4 amazing presentations. Join us again in 2 weeks. We'll do another thing. I don't know what we'll talk about. We clearly have a lot to talk about, and these are great graphs. And I just want to thank again the guests. And you can find all of us on the Bitcoin Braintrust BTC Twitter account and on the YouTube channel that Sina put out. And we'll put this presentation on the YouTube channel as well. So again, thank you very much, guys. And